All right, let's dive in. Today, we're going to pull back the curtain on the limited partnership. It's a really powerful business structure that offers some unique protections and, maybe more importantly, some pretty significant tax advantages. We're going to break down exactly how it works, where the hidden risks are, and why it can be such a game changer for investors and entrepreneurs alike.
Just a quick note, this analysis was put together by Dr. Samir Al-Rashani, with some assistance from AI.
So, let's start at the beginning. What exactly is a limited partnership? You see this structure everywhere, from big real estate deals to high-flying venture capital funds. To really get why it's so popular, we have to start with its legal foundation.
Right off the bat, you need to know this isn't some casual handshake agreement. A limited partnership is a formal legal structure created by state law, kind of like a corporation. And its single most defining feature, the thing that makes it what it is how it legally separates liability among the owners.
So, this whole idea of separating liability leads us directly to the core architecture of a limited partnership. It's built on a mandatory two-class system of owners. We can't have one without the other. Think of them as two pillars holding up the entire structure, and each one has a completely different role and a totally different level of risk.
Okay, so let's get into the nitty-gritty of these two types of partners, the general and the limited. We're going to see how their jobs and, more importantly, their personal risks are just fundamentally different. This is really where the strategic trade-offs of using this structure start to become crystal clear.
And here it is, the essential bargain at the very heart of the limited partnership. On one side, you've got the general partner. They're the ones in the driver's seat, actively managing the business, but, and it's a big but, they take on unlimited personal liability for all its debts. Then on the other side, you have the limited partner. They are purely passive investors. Their financial risk, it's capped at the exact dollar amount they put in. It is the classic trade-off, control for security.
And make no mistake, this distinction is legally binding. If a limited partner ever crosses that line and starts getting involved in day-to-day management, they can actually lose their liability protection and be treated just like a general partner. The roles are meant to be totally separate. One is the money, the other is the manager.
Now, this little diagram gives us a great visual of how the money actually flows into the partnership. You can see the capital contributions coming in from both the general partner and our several limited partners, all getting pooled into one central fund. So, for this example, let's say the total amount they've raised is
$40,000. So this is made up of $10,000 from the general partner and $10,000 from each of our three limited partners. Pretty straightforward, right? But now let's see what that actually means for their personal risk.
Okay, now this is the crucial part for the limited partners. Each one put in $10,000. Now, imagine the partnership goes south and racks up, say, $100,000 in debt. What happens? Well, the absolute maximum financial loss for each of these limited partners is their initial $10,000 investment. That's it. Creditors can't touch their personal assets.
And here's where the immense risk comes in. The general partner, who also invested $10,000, is on the hook for all of the partnership's obligations. Not just their investment, but the whole $100,000. Their personal assets, their house, their savings, it's all exposed. And this, as you can imagine, creates a really serious problem that demands a much more sophisticated solution.
So, because of this extreme risk hanging over the general partner's head, a very clever legal strategy was developed specifically to shield them from that liability. Let's walk through how that works.
So you have to ask, right? Given this massive personal exposure, how can the person actually running the business, the general partner, protect themselves? How can they actively manage the partnership without betting their entire personal net worth on its success?
Well, the answer, and this is super common in practice, is to use another legal entity as a kind of shield. So instead of a person being the general partner, a corporation is put in its place, just like you see in this diagram.
Okay, so here's the playbook. The real owner, let's call it Corporation 1, has a lot of assets, say $500,000. Now, they don't become the GP directly, that'd be crazy. Instead, they create a brand new, separate subsidiary, we'll call it Corporation 2, and they only put a small amount of cash into it, say that $10,000. This new, thinly capitalized company then becomes the official general partner. Now, if the partnership fails, who do creditors go after? They can only touch the assets of Corporation 2, that $10,000. The $500,000 in Corporation 1 is completely safe. The owner keeps control, but has effectively shed all that unlimited liability.
So what's the end result of all this legal maneuvering? Well, from a practical, real-world standpoint, it's pretty profound.
You've essentially created an entity where the limited partners have limited liability by law, and now the general partner has limited liability in practice. The whole structure starts to behave just like a corporation when it comes to protecting its owners.
Okay, so we've built this fortress around liability. Now let's talk about the real reason so many people are drawn to this structure, the tax treatment. This is often the main driver for choosing a limited partnership in the first place.
And it all comes down to something called the conduit principle, or what you might hear called pass-through taxation. The idea is simple. Unlike a corporation, the partnership itself doesn't pay any income tax. It's not a taxable entity. It just acts as a conduit, like a pipe, passing its income or its losses directly through to the partners, who then deal with it on their own tax returns.
The process is incredibly efficient. So the partnership earns some income. That income gets allocated out to the partners according to their profit-sharing agreement. And then the partners simply report that income on their own returns and pay the tax. This simple flow-through completely avoids the dreaded double taxation that corporations have to deal with, where profits are taxed once at the corporate level and then again when they're paid out to shareholders.
Now here's a subtle but really vital detail. The character of the income doesn't change as it passes through the pipe. So if the partnership earns active business income from its operations, it's reported as active business income by all the partners. Yep, even the completely passive limited partners. This little detail can have some major tax implications down the line.
But it's not all upside. There is a very important restriction you have to know about for when the partnership generates a loss, and this rule specifically targets the limited partners.
Essentially, the tax rules just reinforce the economic reality of the situation. Since the limited partner's financial risk is capped at their investment, their ability to deduct any losses for tax purposes is also capped at that exact same amount. You can't claim a tax loss for money you didn't actually have at risk in the first place.
Let's use an example to make that crystal clear. Say a limited partner invests $30,000. The partnership has a bad year, and that partner's share of the loss is $50,000. Well, when they go to file their taxes, they can only deduct $30,000 of that loss. Their deduction is limited to the amount of skin they have in the game.
And that really brings us to the central question, doesn't it? The limited partnership offers this powerful combination of liability protection, especially if you structure it carefully, and incredible tax efficiency, thanks to that conduit principle. Understanding this precise balance between the structural risk and the tax reward, well, that's the absolute key to figuring out if this powerhouse vehicle is the right choice for your particular venture.